Yeah, today is Sunday, the 18th of September, 2022, where we'll be discussing the part 2 of our introduction to financial instruments. Okay, in part 1, extensively we laid the foundation where we were talking extensively with respect to financial instruments from the perspective of presentation, which is in line with IAS 32. And we have extensive discussion yesterday, which I could call part 1, during our part 1 session, and our discussion entails the underlining. Now we more or less try to lay the foundation by saying that we'll be making use of about 3 to 4 standards in all of our discussions with respect to financial instruments, starting from IAS 32, which was what we did in part 1 on presentation. And part 2, we would start with IFRS 9, and we'll more or less continue our discussion in part 2, in part 3, to wrap up IFRS 9, and therefore we'll also venture into IFRS 13, and likewise IFRS 7, as the case may be. Now, today, where we'll be discussing IFRS 9, we'll be looking at things from the angle of classification of financial assets and financial liabilities. We will also be looking at things with respect to recognition principles, okay? And we'll be looking at recognition principles, measurement principles. We extensively discuss on impairment assessment based on the new model. We'll call it expected credit loss model. We'll also look at embedded derivative and the voluntary accounting as regard edge accounting. Okay, and all of those things are what we are expected to cover in the whole process of discussing the requirement of IFRS 9. Okay, now to summarize what we discussed yesterday, we are able to reach a conclusion of what constitutes a financial instrument. And we're able to see that it emanates from a contract that occurs between two parties. On one side of the party, there is a financial asset. On the other side of the party, there is a financial liability or an equity instrument. And one further to define and give examples of what financial assets are, what financial liabilities are, and what constitutes an equity instrument. Okay, we went further to more or less look at various items that might come across in the balance sheet of a company and be able to delineate which one or what combination of those items constitute financial instruments. Okay, we also went further to discuss things about derivatives, especially financial derivatives, and we are able to delineate it to know the characterization to which it can take. Those that are for commitments, which include for contracts, futures contracts, and swap contracts, and those that are considered of contingent claim, which is more or less an option. Okay, we went further to explain what a future contract is, what for contract is, what a swap contract is, and likewise what an option is. And we also venture into discussion with respect to hybrid instruments and compound instruments. And the reason why we need to separate the liability components from the equity component when it comes to a compound instrument. And we look at various ways of splitting such where it is necessary and the conditions precedent to splitting off. Okay, and I believe we also discussed on offsetting principles. We discussed on treasury shares. How do we treat it in a financial statement? We discussed issue regarding the recognition of interest, dividend, and realized gains or losses on financial instruments. And I think we also wrap it up with discussion relating to transaction within equity, how that is taken into consideration. Okay, all of these are what we've discussed in the course of evaluation of the introduction to financial instruments in part 1. Okay, now today we will much more look at the perspective of financial instruments from the angle of recognition, measurement, and the likes. Okay, I'll lay the foundation first before I go back to the presentation material, where we'll more or less have interactions with respect to various discussions we have. Now, there was once IAS 39, which has now been replaced by IFRS 9. Okay, and though our focus will be on IFRS 9, but we also need to understand where we're coming from. IAS 39 has one or two limitations, which did not address certain peculiarities, especially during the financial crisis of 2007, 8, and 9. And some of those shortcomings requires the total overhaul of the standards, and that is what gave birth to the adoption of IFRS 9 beginning 1st of January 2018. Okay, and where necessary, I might make reference to areas of differences between IAS 39 and IFRS 9. But again, IFRS 9 derives its life primarily from IAS 39. Okay, now let me start with IFRS 9. And I'll start from the angle that IFRS 9 speaks to two things: financial assets and speak to financial liabilities. In all respects, starting from initial recognition up to the end point of the recognition. In between, we have measurement and the likes. Okay, now IFRS 9, we'll be looking at the classification. We'll start with classification. Of financial instruments. Now we have restricted it to two. Why these two? Because these two are what can be remeasured. These two can be remeasured, which means they are measured on a continuous basis, unlike equity, that is only measured once, which is at the point of initial recognition, and subsequently, equity is a residual. And our measurement and other effects is a consequence of classification. And therefore, what is classification? It's simply the grouping of financial instruments based on some homogeneous factors or common factors. Now, let me start with the diagram. We have the financial assets on one side, and I have the financial liability on the other side. For the assets, we have three buckets. or three classes. We have the class we consider as fair value to profit or loss. The class we consider amortized costs. And the class we consider fair value to other comprehensive income. Whereas for financial liability, we have two classes: fair value to profit or loss and amortized cost. Now let me define them one by one. Fair value to profit or loss, which is a class. Fair value through other comprehensive income, which is a class. Amortized cost, which is also a class. And we explain the uniqueness of these classes. Okay. Now, let me just give you a clue before we go into the details. This class and this class have some things in common. And what they have in common is that they measure the financial assets at fair value. In similar vein with this, but this is from the liability perspective. Whereas this class and this class, though they are looking at it from asset and liability, they have something in common. Rather than measure at fair value, they measure at amortized cost. Okay, but later we'll come back to what fair value is, what amortized cost is. But the next question we ask is this: what are the attributes that can be used to classify various financial instruments? If you remember, the likes of trade payables, trade receivables, swaps, option forward, callable bond, putable bond, and the likes. How do we classify them into any of this? Now I'll start with fair value to profit or loss buckets. Now, this class belongs to those financial assets that are held for trading. What does that mean? These are financial assets that you buy and you sell for the purpose of obtaining capital appreciation. And the evidence of such should be within 3 months, which means these are assets in which entities speculate upon for capital appreciation purposes, where you trade actively as a portfolio investment. And such financial assets will be classified under this bucket. There are also some that are not traded upon, but they are financial assets which at initial recognition are designated to be measured at fair value through profit or loss. The reason for this is to avert mismatches. What does that mean? They are not necessarily financial assets that are held for trading purposes, but they are financial assets that are held to meet certain defined obligations. And naturally, they may not fall under the bucket of fair value through profit or loss, but because of the fact that the liability to which they are held for may have been measured at fair value through profit or loss, or their effect passes to profit or loss. Therefore, there may be mismatch in the timing recognition of the impact in the profit or loss. And therefore, to avoid this mismatch, we therefore take an option to designate it as a financial asset which ought to be measured at fair value to profit or loss. And the third one are derivative assets. All derivative assets are to be measured at fair value through profit or loss. Which means any financial asset that meets any of these attributes will be considered suitable for this bucket. We also have a bucket, the amortized cost bucket. First, this bucket is only available to debt securities. What that means is that because only debt securities that have contractual cash flows, which are usually predetermined. And two, not all debt securities may fall under this amortized cost bucket. Why? Because some of these debt securities may be held for trading, and therefore they will not have fallen under this bucket. But for a debt security to fall under this bucket, such debt securities must pass these two tests. What are the two tests? We'll carry out a test we'll call business model test. This is a test where we'll look at the business model of holding such a debt security. And we'll find out that the primary source of realization of the economic value or benefits associated with such debt security is solely of principal and interest. And in addition to that, it must also pass the second test, which we call the contractual cash flows characteristics model test. The test that shows that principally, not only that we have the objective that the cash flow associated with these financial assets is intended from principal and interest, or principal and interest, or both, but also we can demonstrate the capacity that such benefit will be solely of principal and interest. And we're going to look at those two tests thereafter. Now, it is when we have met all of these conditions that a financial asset will be default as amortized cost, which means, for example, certain financial assets can never fall here. Example of them are equities. Any equity investment cannot fall as amortized cost because they are not debt security, neither do they have contractual cash flow that is predetermined. Therefore, it's only debt securities. As such debt security to be here, it must not be held for trading until it means they must have passed all of these tests, business model tests, and the contractual cash flow characteristics model test. Now, what can we say about the third bucket? The third bucket, technically, I can see it as a bucket that is more or less a residue. What does that mean? This is a residue class or category in which financial assets that do not fall in either of fair value to profit or loss or amortized costs are defaulted, that is, are grouped. Okay, in this case, you can find securities like equity that neither are they designated for to be measured at fair value, nor are they held for trading. And we're going to look at a flowchart to addressing that. Also, you can have, in a real situation, debt securities that are not held for trading and may have passed the business model test, but failed the contractual cash flow characteristics model test, which means in passing contractual characteristics model test, it means you have all of what it takes to collect all of the principals and interest associated with the debt security without any option of selling. But where you have an option to sell, when you choose to do so, it then means he has failed this test. and therefore it defaults here. Which means a debt security that has passed 1 and has passed 2A but failed 2B will automatically come under this last bucket, since it failed to fall here because it's not held for trading purposes. And neither was it held for the sole purpose of meeting a liability, and you are not in the position of averting any mismatch. And that is it. But again, take note, at every point in time, derivative assets are only going to belong to a single class. And what is that class? Fair value to profit or loss. In similar vein, we'll look at liabilities. Now, what we just finished are for assets. Financial assets. Financial what? Assets. Okay, now for financial liabilities. We have 2 buckets. The first one is fair value to profit or loss. In similar vein, financial liability that are held for trading purposes are classified under this bucket. The question you now ask yourself is, how on earth can you hold financial liability for trading purposes? Example of financial liability that can be held for trading purposes are those ones that are more or less traded financial liability. For example, you issue a callable bonds, or you have commercial papers and some other things in which, based on the movement in yield curve and expectation with respect to interest rates, you might see opportunity of refinancing so that you might reissue another one to pay off another one, and thereby you taking advantage of movement in market interest rates. And therefore, it's also possible to trade in your liability towards your own benefits. Or you have a liability that, in order to avoid accounting mismatches, such financial liabilities at initial recognition are designated at fair value to profit or loss. And finally, all derivative liabilities, we have this bucket as a default bucket. Otherwise, other liabilities that do not meet the criteria of fair value to profit or loss will by default be in what? Amortized cost, AC. Which means once you fail that test, the only bucket available to you is amortized cost. And that is a position at that point in what? In time. Any questions so far? Any questions so far? Any questions so far? Okay. Now, if there's no question, now let me turn to the presentation slides to have one or two other discussions. And probably that can trigger a question, and I'll make one or two explanations. Okay, can somebody read this out for us?
IFRS 9, financial instruments. IFRS 9, classification of financial assets and financial liabilities. The categories into which the asset is classified determines how it is measured subsequent to initial recognition, either at amortized cost or at fair value. 2. Entities may no longer measure investment in unquoted equities or derivatives at cost. They must be classified into one of the categories permitted by the standard. 3. However, cost may be in some instances an appropriate approximation of the fair value of an investment. 4. Financial assets are initially measured at fair value plus, in the case of a financial asset not at fair value, to profit or loss, transaction cost.
Now you can see what I've explained earlier. And from here, you can see clearly that financial instruments, from the angle of recognition and classification, financial assets can be classified into 3 buckets: fair value to profit or loss, fair value to other comprehensive income, and amortized cost. While financial liability can be classified into fair value to profit or loss and amortized cost. Okay, now look at this. How you classify is also a function of this chart. And this chart was provided by IESB. This is what I would call, I mentioned it earlier, decision tree, or there's a name I wanted to use. Okay, but it's going to guide us in terms of how we know whether it falls under amortized cost, fair value to profit or loss, or fair value to other comprehensive income. But what I've done for you is that I've summarized them in a practical sense using illustration, as I've explained earlier, to make it much more easier. But again, you appreciate this also. Now, the first thing you need to ask yourself is that the instrument you are talking about, is it within the scope of IFRS 9? If not within the scope, therefore you don't need to bother yourself, which means if it's not IFRS 9, that means it's not a financial instrument, probably it's something else, and another standard will take care of it. But if it's within the scope of IFRS 9, therefore what do you need to take into consideration? 1, the contractual cash flow. You ask yourself this question. And what's the question? Are the contractual cash flow solely of principal and interest? If your answer is categorical no, it then means that it goes here straightforward as fair value to profit or loss. But if you have answered yes, another question may be necessary. And what's that question? Are those financial instruments held to collect contractual cash flows only? If you say yes, you now look at an option you have. Do you intend at the point of initial recognition, try to take the option of fair value, probably to avoid accounting mismatches? If your answer is yes, it goes to fair value to profit or loss. But if the answer is no, you are not taking such an option, automatically it defaults at amortized cost. But if I come back here, what if the question says, are the financial assets held to collect contractual cash flow only? And I said no. There will be a further question I need to ask. And what is that question? Is that are the financial assets held to collect contractual cash flow and probably to sell prior to maturity? If I say categorical no, it comes at fair value to profit or loss. But if I say yes, I also ask myself, am I trying to take an option just to avoid accounting mismatch and therefore measure it at fair value? If I say yes, it comes to fair value to profit or loss. But if I say no, I'm not taking such an option. Therefore, I'll have to measure it at fair value through other comprehensive income. And that is the position there. Does that make sense? Does that make sense?
Okay, sir. Okay.
Okay.
Yes, sir.
Which means if I quickly come back on this, you cannot see the sense it has made on what I explained earlier. And as I've explained earlier, what sense has it made? I said, for financial assets that are held for trading, they come here. For financial assets that may not have been held for trading, but at initial recognition, they've taken an option to designate as fair value through profit or loss in order to avert accounting mismatches, they also come here. Or for derivative what? Assets, they come here. Now for amortized cost, first I said debt security because debt security have contractual cash flow, which speaks to those questions there. And two, you must have passed two tests, the business model test and the contractual cash flow characteristic model test. Otherwise, if you only pass the business model test, which was the first test, automatically, and you failed the second test, which is the contractual cash flow characteristic model test, automatically you default into the fair value to OCI buckets. And that's what I've said there. Okay, and for financial liability, I've said all financial liabilities that are held for trading purposes will fall under these buckets, or those ones that because you want to avert accounting mismatch, you've designated them by taking a fair value option at initiation. Therefore, you still take them under this bucket, or if they are derivative liabilities. Otherwise, if they fail to meet this bucket, automatically they default at amortized cost. Okay, that's that. Now, can somebody take us through this? And this speaks to the fact of trying to understand the business model test and the contractual characteristic model test.
The IFRS 9 classification. Classification of financial assets. The IFRS 9 classification is made on the basis of both the entity business model for managing the financial assets and the contractual cash flow characteristics of the financial asset. Fair value through profit or loss Fair value through profit or loss. All other debt instruments must be measured at fair value through P or L. Fair value through P or L option to avoid an accounting mismatch. A financial amortized cost. A financial asset is classified as measured at amortized cost, where the objective of the business model within which the asset is held is to hold assets in order to collect contractual cash flows. And the contractual terms of the financial asset give rise on specific date to cash flow that are solely payment of principal and interest on the principal outstanding. Fair value through OCI. A financial asset must be classified and measured at fair value through other OCI unless the asset is designated as fair value through profit or loss under the fair value option if it meets the following criteria. The financial asset is held within a business model whose objectives are achieved by both collecting contractual cash flow and selling financial assets. The contractual term of the financial asset give rise on specific date to cash flow that are solemnly payment of principal and interest on the principal amount outstanding. That's all. Mr. Muwa, I'm done.
Okay, can somebody else now take it up from here also to explain some other salient things I've mentioned earlier?
Fair value through profit or loss. All other debt.
Can you hear you, Samuel?
Okay. Fair value through profit or loss. All other debt instruments must be measured at fair value through profit or loss. Fair value through profit or loss option to avoid an accounting mismatch. That's the second one. Even if an instrument meets the above criteria for measurement at amortized cost or fair value through other comprehensive income, IFRS 9 allows such financial assets to be designated at initial recognition as being measured at fair value through profit or loss if a recognition or measurement inconsistency, that is an accounting mismatch, would otherwise arise from measuring assets or liabilities or recognizing the gains and losses on them on different bases. Equity instruments. Equity instruments may not be classified as equity instruments may not be classified as measured at amortized cost and must be measured at fair value. This is because contractual cash flow on specified dates are not a characteristic of equity instruments. However, if an equity instrument is not held for trading, an entity can make an irrevocable election at initial recognition to measure it at fair value through other comprehensive income, with only dividend income recognized in profit or loss. This is different from the treatment of debt instruments, where the fair value through other comprehensive income classification is mandatory for assets meeting the criteria, unless the fair value option through profit or loss option is chosen. On recognition, IFRS 9 requires that financial assets are classified as measured as at either A, at fair value through profit or loss, or B, financial liability at amortized cost. A financial liability is classified at fair value through profit or loss if A, it is held for trading, or B, upon initial recognition, it is designated at fair value through profit or loss. This is permitted when it results in more relevant information because, one, it eliminates or significantly reduces a measurement or recognition inconsistency, that is accounting mismatch, or two, it is a group of financial liabilities or financial assets and liabilities, and its performance is evaluated on a fair value basis in accordance with a documented risk management or investment strategy. Derivative are always measured at profit or loss, at fair value through profit or loss.
Thank you very much. Now let's come back here. Therefore, I've laid that foundation. Now the next thing is this. What is the implication of this classification, or what are the implications? The implications borders on the following. One, subsequent measurements of the financial instruments. In this case, financial assets and financial liabilities. They have no implication on initial measurement or recognition, but I'll still give you a clause in it. And secondly, the implication also borders on the impacts in either of profit or loss on one side or other comprehensive income on the other side. Now, let me use Excel to speak to that. This was the Excel we used yesterday to carry out the splitting of compound instruments. Implications of classification of financial assets. Let me start with the assets. The classes, fair value, true, profits, or loss. Fair value, true, other comprehensive income. And amortized cost. Sorry, how's that? Okay. classes or categories. Now, basis or reference points. Okay. Now, the first thing I'm going to consider I'm going to look at it from the angle of initial recognition and measurement. That means at the point of initial recognition and measurements, all financial instruments, I repeat, all financial instruments are to be measured at fair value. Now, initially, we are going to consider fair value as something very close to market value. But later on in the course of our discussion, we will discover that fair value goes beyond market value because there are about 3 hierarchy levels for fair value. But at this point, we'll assume fair value is the market price or market value. But later on, when we get to IFRS 13, we'll discuss extensively, and from there, we appreciate that fair value is probably the price that will be received to sell an asset or that will be paid to transfer a liability in what is perceived to be an orderly transaction between market participants at a measurement date. And it's also something you can view as a measurement date price that is received to sell an asset or that is paid to transfer a liability in an orderly transaction between market participants. We are still speaking to the same thing. Our fair value comes with 4 attributes or factors, which we're going to discuss later. What are they? Price, asset and liabilities, which is a reference point, transaction cost, and measurements, basis, and period, or what we call the dates. We'll discuss that extensively later. But what I can say here is this. All financial assets, regardless of their classification, are to be measured at fair value. That is number 1. Which means probably what I can do here is let me collapse it and just make it fair value for each. Okay, I think that will be better. Okay. Second thing is, how do we treat transaction cost? What are transaction costs? Costs you need to incur to enter into that transaction. For example, if you want to buy shares, you don't just walk up and say, I'm buying shares. You buy to a broker, you pay commission, you pay stamp duty, you pay all sorts of things. Therefore, all of those costs are considered transaction costs. You want to raise money from the market, you issue bond, you issue shares, you have to go through primary markets, you have to pay some regulatory fee, you have to pay brokerages and all sorts of things. All of those costs are transaction costs. Therefore, when you incur such costs, the treatment is a function of the classification. And what is that? If the financial asset is measured at fair value to profit or loss, you will simply treat the transaction cost as a charge to profit or loss. You treat it as a charge to profit or what? Or loss. Whereas, if the classification is fair value to other comprehensive income, the transaction cost will be added to the fair value, which means, for example, if the fair value is 1 million and transaction cost is 10,000, it will now be 1 million and 10,000 being the carrying amount of that financial asset. But in this case here, it will still be 1 million, all because the 10,000 has been expensed. And likewise, if it's amortized cost, it's also going to be added to the value of the financial what? Assets.
So
Next.
can you explain the OCI again? Fair value through OCI.
We said transaction costs incurred on a financial asset that falls under this bucket of OCI will equally be added to the initial purchase price, which is a fair value. Remember, fair value at initiation usually is equal to the purchase price. That is the amount you pay to enter into it, except in a rare situation where it may not be the same. And we are going to discuss that situation later. But any price you enter into at that point in time is considered fair value, except otherwise proven. Okay, let me see whether I can have a symbol I can get here that I can use as approximation. There's a symbol I can use here. Symbol, approximation. I should have it somewhere here. This closer to what is upward shifting. Okay, what I'll just leave it as is equals to. Okay, I'll leave it at that. Okay. Now, subsequent measurements, which means subsequent measurement comes at each reporting date, which can be monthly, quarterly, or otherwise, but at least annually. At each reporting date, how do you measure it? From the word fair value, yeah, it means both of them are to be measured at fair value. Whereas this will be measured at amortized cost. It means at every point in time, you check the market value of these instruments, and the new market value will become the new value. But what is amortized cost? We'll come back to it later. Next, how do we treat fair value gains or fair value losses? In this case, the fair value gain or losses is charged or credited, as the case may be, to profit or loss. And in this case, rather than profit or loss, it is charged to OCI. And in this case, it is not applicable. Who can tell me why it's not applicable?
Since the subsequent measurement is not at fair value.
Fair value. Thank you. Yeah. How do you treat treatment of dividend income? Dividend income will only relate to either of these two buckets. And in that case, it will be credited to profit or loss, regardless of whether it's measured at fair value to profit or loss or measured at fair value to other comprehensive income. But it's not applicable here. Who can tell me why it's not applicable here?
Probably because it's not an equity instrument like.
Because shares and shares can never be classified under this bucket. This bucket is for debt security. as holding debt security as contractual cash flows. Therefore, how do we treat interest income? Interest income arose from debt securities, and debt security can take any of these three categories. They will all be credited to profit or what? Or loss, regardless of the category. Impairment loss. Treatment of impairment loss. How do we treat impairment losses? Impairment loss is not applicable to this category. Who can tell me why? Because the fair value loss or gain that is reported to profit or loss has invariably taken care of that impairment losses. Whereas impairment loss here will be charged to OCI up to the point of nil off of any earlier recognized fair value gains. Which means if there's fair value gain reported before and you now have impairment loss, which is very rare, and such loss must be considered to be permanent nature, you will use that loss first to reduce the fair value gain that has been recognized earlier and put in a reserve, which you call fair value reserve. And until you have nil off that reserve before you can charge any excess to profit or loss. Therefore, any excess can then be charged to profit or loss. But again, before you charge impairment in this case, it is more seen as of a permanent what? Nature. But here, it is charged to profit or loss. Similarly, the treatment of impairment gains. And we're going to discuss that. Can we have impairment gain? The answer is yes. But you can have impairment gain that is in excess of previously recognized impairment losses. We won't get to impairments as a discussion. We will look at it at that point in time. Then put it in red as a way of emphasizing this. Okay, these are the consequences relating to the measurements, subsequent measurements, initial and subsequent measurement of each category. Similarly, I can do that for the liability. Now there are two buckets for liabilities. Initial recognition, as we said earlier, it is still at fair value. Transaction costs in this case will still be charged to profit or loss for fair value to profit or loss. But here, it will be deducted from the fair value. Why is it deducted? I'll give you an example. If you borrow loan from the bank, and you borrow 1 million naira, and the bank charges you 10,000 naira as processing fees, management fees. Now, net, what the bank is giving to you is 990, and that's what we have done. Whether you are paying the 10,000 before they give you the 1 million, or they gave you the 1 million and they are deducting 10,000, net, your net effective borrowing is now 190, and that's what we are talking about. The fair value of the loan is the 1 million, and 10,000 is the transaction cost, which means your net proceed is 990, and that's what we've done here. Okay, subsequent measurements. You measure that at fair value to profit or loss at fair value, and amortized cost at amortized cost. And where there's a fair value gain, loss, you report it here. And I'm going to asterisk it. I'll asterisk it because of something. And I will explain. Whereas here, it is not applicable because it was not measured at fair value. Interest expense. When you have interest expense, it will be charged to profit or loss regardless of the classification. Remember, we discussed that also under IAS 32. And that is that. Now, let me give you a clue here. The clue here is this. Where there is a fair value gain on financial liabilities, and a portion can be attributed to own credit risk. Such will be reported through other comprehensive income, OCI. Whilst the other portion, due to market factors, will be recognized in profit or loss. and I'll explain. Okay. Okay, now we can see it here. Now, what this means is that if you trade on your liability, which I explained earlier, and you are trading on the premise that your credit rating has dropped, and because of it has dropped, your cost of borrowing will increase. And since you measure your liability at fair value, the fair value measurement may be an approximate of the present value. Remember, we discussed present value, fair value, and current cost as a basis or a surrogate for obtaining the current value of an item. Therefore, that may have necessitated a gain that you are reporting, and such gain should not go to your profit or loss, rather it should go to OCI. But if it is as a result of market factors, such that there's a general increase in market rates, which is not instrumental from your own credit rating, in that case, such portion will go to profit or loss. And sometimes those two events might occur at the same time. You now have to delineate, analyze it, and split the profit, fair value gain, into the portion that is attributed to your credit deterioration, which you call your own credit risk, and take that portion to OCI. And while the other portion that is based on general market factors or indices will go to your profit or loss. And that's what I'm trying to explain there. Okay. That is that. Any other question? Which means I can copy this and somewhat bring it to the notes. Any question? Any question? Okay, if there's no question, let's now go to the presentation slide. And I want somebody to assist me here. Can somebody assist me? This explain further all what I've explained or done earlier. Okay? I'm waiting. It seems your network is bad. Somebody else? Your network is bad.
IFRS 9 financial instrument. Can you hear me, sir?
Yes, we can hear you now.
Initial recognitions. Financial instruments are recognized on the statement of FP when the entity becomes party to the contractual provision of the instrument. Initial measurement. All financial instruments are measured initially at fair value. Directly attributable transaction costs are added to or deducted from carrying value of those financial instruments that are not subsequently measured at fair value through POL. Fair value is the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between a market participant at the measurement date. See IFRS 13 fair value measurements. Directly attributable transaction costs, incremental costs that are directly attributable to the acquisition, issue, or disposal of a financial asset or financial liability. Subsequent measurements. Subsequent measurements depend on the category into which the financial instrument is classified. Next slide. Subsequent measurement of financial assets. IFRS 9 divide all financial assets that are currently in the scope of IFRS 39 into two classifications. Those measured at amortized cost and those measured at fair value. Where assets are measured at fair value, gains and losses are either recognized entirely in profit or loss, fair value through POL, or recognized in other comprehensive income, fair value through other comprehensive income, FVTOCI. For debt instrument, the financial fair value through OCI classification is mandatory for certain assets unless the fair value option is elected. With for equity instruments, the fair value through OCI classification is an election. Furthermore, the requirement for reclassifying gain or losses recognized in other comprehensive income are different for debt instruments and equity instruments. The classification of a financial asset is made at the time it is initially recognized, namely when the entity becomes a party to the contractual provision of the instrument. If certain conditions are met, the classification of an asset may subsequently need to be reclassified. Next. Okay. Subsequent measurement of financial instrument, debt instruments. A debt instrument that meets the following two conditions must be measured at amortized cost, net of any write-down for impairment, unless the asset is designated at fair value through POL under the fair value option. Business model test. The objective of the entity's business model is to hold the financial asset to collect contractual cash rather than to sell the instrument prior to its contractual maturity to realize its fair value changes. Cash flow characteristics test. The contractual term of the financial assets give rise on specific date to cash flow that are solely payment of principal and interest on the principal amounts outstanding. Subsequent measurement financial instruments, debt instruments. A debt instrument that meets the following two conditions must be measured at fair value through OCI unless the asset is designated at fair value through profit or loss under the fair value option. I think this is what I just finished reading.
No?
Business model test. The financial asset is held within a business model whose objectives are achieved by both collecting contractual cash and selling financial assets. Cash flow characteristics test. The contractual term of the financial asset gives rise on specific date to cash flow that are solely payments of principal and interest on the principal amount outstanding. All other debt instruments must be measured at fair value through profit or less. Fair value option. Even if an instrument meets the two requirements to be measured at amortized cost or fair value through OCI, IFRS 9 contains an option to designate at initial recognition a financial asset as measured at fair value through profit or losses. Doing so, eliminate or significantly reduce a measurement or recognition inconsistency, sometimes referred to as an accounting mismatch that would otherwise arise from measuring assets or liability or recognizing the gain and losses on them on different bases. Equity instrument. All equity instruments in scope of IFRS 9 are to be measured at fair value in the statement of financial position, a value change recognized in profit or loss, except for those equity investments for which the entity has elected to present value change in other comprehensive income. There is no cost exception for unquoted equities. Other comprehensive income option, if any equity instrument is not held for trading, an entity can make an irrecoverable election at initial recognition to measure it at fair value through OCI with only dividend income recognized in profit or loss. Measurement guidance. Despite the fair value requirement for all equity instruments, IFRS 9 contains guidance on when cost may be the best estimate of fair value and also when it might not be representative of fair value. Subsequent measurement of financial liabilities. IFRS 9 does not change the basic accounting model for financial liabilities under IFRS 39. Two measurement categories continue to exist: fair value through profit or loss and amortized cost. Financial liabilities held for trading are measured at fair value through profit or loss, and all other financial liabilities are measured at amortized cost unless the first value option is applied. Fair value option. IFRS 9 contains an option to designate a financial liability as measured at fair value if IFRS 9 paragraph 2 subsection 2 subset 2. Doing so, eliminate or significantly reduce a measurement or recognition inconsistency, sometimes referred to as the accounting mismatch. There would otherwise arise from measuring asset or liability or recognizing the gain or losses on them on different bases. On the liability is part or a group of financial liability or financial assets or financial liability that is measured and its performance is evaluated on a fair value basis in accordance with a documented risk management or investment strategy, and information about the group is provided internally on the basis to the entity key management personnel. Subsequent measurement of financial liability. A financial liability which does not meet any of these criteria may still be designated as measured at fair value through profit or loss when it contains one or more embedded derivatives that subsequently modify the cash flow of the liability and are not closely related. IFRS 9 requires gain and losses on financial liability designated as a fair value through profit or loss to be split into the amount of change in fair value attributable to change in credit risk and of the liability present in other comprehensive income and the remaining amount presented in profit or loss. The new guidance allows the recognition of the full amount of change in fair value in profit or loss only if the presentation of changes liability credit risk in other comprehensive income will create or enlarge an accounting mismatch in profit or loss. That determination is made at initial recognition and is not reassessed. Amounts presented in other comprehensive income shall not be subsequently transferred to profit or loss. The entire entity may only transfer the cumulative gain or loss within equity. Subsequent measurement of financial liability. Credit risk. IFRS 9 requires that financial liability which are designated as measured at fair value through profit or loss are treated differently. In this case, the gain or loss in a period must be classified into gain or loss resulting from credit risk and gain or loss. This provision of IFRS 9 was in response to an anomaly regarding changes in credit risk of a financial liability. Changes in financial liability credit risk affect the fair value of the financial liability. This means that when an entity credit worthiness deteriorates, the fair value of its issued debt will decrease and vice versa. For financial liability measure using the fair value option, this causes a gain or loss to be recognized in profit or loss for the year.
Thank you very much. Thank you very much. Thank you. Now, we will now more or less look at practical aspect of all what we have discussed as a means to gaining more understanding in this case. But before then, I want someone, probably Madam Dari, to more or less look at the scope of financial assets and liabilities that are reported or to which IFRS 9 applies. Remember, we said something when we were looking at that decision tree or flow charts. We said we need to first of all consider whether what we are looking at is within the scope of IFRS 9 before we can start to answer some other questions. Now, on that premise, can you more or less look at this for us? Recognition of financial instruments.
Okay, sir. Recognition of financial instruments. All financial assets and liabilities should be recognized in the statement of financial position, including derivatives. Financial assets should be recognized when the rights to the cash flows from the asset expire, or where substantially all the risks and rewards of ownership are transferred to another party. Financial liabilities should be recognized when they are extinguished. IFRS 9 establishes principles for recognizing and measuring financial assets and financial liabilities. IFRS 9 is mandatorily effective for periods beginning on or after 1st January 2018, with early adoption permitted. Scope. IFRS 9 applies to all entities and to all types of financial instruments, except those specifically excluded, as listed below. IFRS 9, Chapter 2, Paragraph 2.1. A. Investments in subsidiaries, associates, and joint ventures that are accounted for under IFRS 10, IAS 27, or IAS 28. B. Leases covered in IFRS 16. C. Employee benefit plans covered in IAS 19. D. Equity instruments issued by the entity, e.g. ordinary shares issued or options and warrants. E. Insurance contracts and financial guarantee contracts. F. Contract for contingent consideration in a business combination covered in IFRS 3. G. Loan commitments that cannot be settled net in cash or another financial instrument. H. Financial instruments, contracts, and obligations under share-based payment transactions covered in IFRS 2. I. Rights to reimbursement under IAS 37. J. Rights and obligations within the scope of IFRS 15, revenue from contracts with customers. Should I continue, sir?
Yes.
Initial recognition. Financial instruments should be recognized in the statement of financial position when the entity becomes a party to the contractual provisions of the instrument. IFRS 9, Chapter 3, Paragraph 3.1.1. An important consequence of this is that all derivatives should be recognized in the statement of financial position. Notice that this is consistent with recognition criteria in the conceptual framework, which requires there to be a potential to produce economic benefits. Conceptual framework, paragraph 4.4, but is inconsistent with most other standards, which normally require an asset to be recognized when there is a probable inflow or outflow of resources and
Okay, and the item has a cost or value that can be measured reliably. Okay. Okay. Reliably. Sorry, sir. Okay. Example, initial recognition. An entity has entered into two separate contracts. A firm commitment and order to buy a specific quantity of iron. B, a forward contract to buy specified provided delivery of the iron is not taken. Contract A is a normal trading contract. The entity does not recognize a liability for the iron until the goods have actually been delivered. Note that this contract is not a financial instrument because it's a physical asset rather than a financial asset. Contract B is a financial instrument, IFRS 9. The entity recognizes a financial liability, an obligation to deliver cash on the commitment date and waiting for the closing date on which the exchange takes place. Note that planned future transactions, no matter how likely, are not assets and liabilities of an entity. The entity has not yet become a party to the contract. The recognition of financial assets.
Thank you. Okay. Now we'll enter a phase that will probably demonstrate our understanding in practical sense some of those things we discussed earlier. And that is on the premise that we'll be looking at the following terminologies. Okay, one of those terminologies is what we call amortized cost. Okay, earlier on we have looked at fair value, and at this point I said look at fair value from the angle of the market price. But later on we'll come back to look at fair value from three angles, which we call the hierarchy levels: level 1, level 2, and level 3, of which market value, or what we call the quoted prices, unadjusted quoted prices, is the highest level, which is level 1. Okay, but now we'll look at amortized cost. What is an amortized cost? Amortized cost is more or less the fair value of a financial asset or liability at initial recognition, which has been adjusted for changes or movement arising from amortization of certain transaction costs or certain implied costs inherent either at the beginning, in between, or at the end of that transaction. And what we are trying to do there is that any cost incidental to carrying out or being a party to that transaction, which is expected to more or less ensure that we continue to hold on to that transaction from the beginning to the end, rather than expensing them or recognizing them as income at the period they were paid for or received, will rather recognize them over the average life of the asset or the liability in a systematic manner. Which means rather than recognizing it as a spot, we amortize those costs over the period of the average life of that financial instrument. Again, all what I've said is still grammar. Even when you read the definition according to standard, it's still grammar. But to more or less de-grammatize it, we'll look at practical illustrations and we'll use the aid of our Excel models or spreadsheet models to delineate what we perceive as what we understood by amortized cost. But in carrying out amortized costs, we can only do that with the aid of a methodology. Amortized cost is a measure, but that measure is obtained from a methodology. And such a methodology is what we know as the effective interest method. And this is a method that assists us in establishing a single rate, a discount rate, or interest rate, or implied rate that can be used to carry out effective amortization of those costs we are talking about, which are inherent in ensuring that we hold on to a financial asset or financial liability over its average economic life. And that methodology, again, is all called the effective interest method. And it's that methodology that will make us obtain what we call the effective interest rate, which is the discount rate we are going to imply to ensure that we are able to effectively equate the whole of the present value of outflow to the present value of inflow in relation to a financial asset or a financial liability. And such effective interest rate is otherwise known in the investment community as the internal rate of return. It's known in the bond or debt security community as the yield to maturity. But in financial reporting perspective, we'll be talking about effective interest rate. And this is a singular rate that approximates all of the contractual cash flow such that when you sum it up at present value, they sum up to zero. Or conversely, it equates the present value of all outflow, regardless of the time and period, to the present value of inflow, regardless of time and period. And that's what we're talking about. And we're going to look at it in practical sense with various illustrations. Okay, and that will take us back to our question bank that will give us a guide to us having this understanding. Okay. Any question before we proceed further? Any question? Any question?
None for me.
Okay, let's start with question 1. And I want somebody to read it for us. Can somebody read question 1?
In okay, question 1. Arsenal PLC acquired a deep discount instrument of the face value of 10 million naira for a price of 9.1 million naira. The investment horizon for the instrument is 3 years required. Determine the effective interest rates EIR of the instrument. B.
Your network is
construct the amortization schedule for amortized cost measurement. C. Show the relevant account entries for the respective years.
Okay, can somebody read it again because your network was breaking seriously through the course of your reading? Can somebody read again?
Okay. Question 1. Arsenal PLC acquired a deep discount instrument of the value of 10 million for a price of 9.1 million. The investment horizon for the instrument is 3 years. Required A. Determine the effective interest rate of the instrument. B. Construct the amortization schedule for amortized cost measurement. Then C. Show the relevant account entries for the respective years.
Okay. Thank you. Now, I've copied the question into this spreadsheet. Now, what then do we do? I brought out the information. Now, the first thing is this. Are we investing in a bond or we are issuing bond to raise money? in this case. We are Arsenal. Therefore, what are we doing? Are we investing or are we issuing bond to raise money? What are we doing? I can't hear anyone. And I can't see your chat. Arsenal acquired a deep discount instrument. The word acquire means we invested. Investment in a discount bond. Okay, and bond that investing in this case is a financial asset. We must take note of that. Okay. Now, the face value of the bond, what does it mean by face value? Face value means how much we are going to realize when the bond matures. But we are buying the bond for 9.1 million naira today. And the bond does not pay coupon. A bond that does not pay coupon is a discount bond, which you always buy at below the par value. And inherently, your return from the bond is the difference between how much you get at the maturity and how much you invested or you purchase it for. Okay, and the duration of the bond here is 3 years. Now the question then is, we need to determine the effective what? Interest rate. Now to determine the effective interest rate, what then do we need to do? What we need to do, again, I'll draw up a timeline. This is the timeline. Permit my straight line. Today, year 1, year 2, and year 3. Today, I'm investing 1 million. In year 1, my cash flow in year 1 is 0 because there's no coupon, no interest to be paid. Sorry, today I invested 9.1, not 1 million. 9.1 million. 9.1 million means 9,100,000. Year 2, my cash flow is also 0. And year 3, my cash flow is a face value, which is 10 million. Now, what then should I do? Is for me to find a rate so that if I discount this back in one period back, this back in 2 periods, and this back in 3 periods. I will sum up this, which means 9 million equals to me discounting this by 1 plus R, discount this raised to power 1 by 1 plus R, raised to power 2, and discount this by 10 million, 1 plus R, raised to power 3. Now, the beauty of it is this. Everything divided by 0, or 0 divided by anything is 0.
I think not 9,100,000.
9,100,000.
9,100,000, thank you. And this is now 10 million over 1 plus R raised to power 3, which means this is 9,100,000 equals 10 million 1 plus R3. This is equal to present value of the future value discounted by 1 plus R raised to power n. And if you can remember this formula. Okay, which means intuitively, instead of me just giving you this formula, I try to walk you through how we derive that formula. Now, in this case, we are now saying that what is our R? Our R is the effective interest rate that when we use it to discount all of these future cash flow to present, they equate, or of which the sum becomes 0. And that is it. Okay, how do we get it? There are many ways you can get it. We can use Excel straightforward to get it. In Excel, the function is known as IRR. In Excel, derived. In Excel, it is known as IRR, which means in Excel, I can derive it as follows. In Excel, I'll use IRR as a function, and I can also use rate as a function. Okay? Now, let me use rate as a function and see whether I'll get it. I'll say is equals to rate. I open the brackets. Now, once I do that, I can come to this function bar and open it up. And I can follow the instruction. What is the number of period? The number of period is 3 years, which is this. What is the payment? There are no intermittent payments, no payment of coupon during the life of that investment. Therefore, the payment is 0. What is the present value? The present value is the outflow I'm parting away with now because I'm buying a bond. Therefore, I'm parting away with 9.1 million. I put it in negative. What will I get in future? I'll get 10 million in future, which is this. Now, this is based on accrual, which means I'm going to use 0. 0 means you only accrue interest at the end, not at the beginning, which means in advance. If it's in advance, it becomes 1. But again, naturally, it's at the end. And at the end of the day, I'm able to get my effective interest rates to be what? Let me expand it to be 3.19. Again, it's just approximation by 3.19. If you are to look at it extensively, I can increase it to as many decimal points as possible. I can say this is it. Alternatively, I can use IRR function. But for me to use IRR function, I'll need to construct a table. And what's the table I have to construct? I'll show you. Okay. Now, my outflow was 9.1 million. Is a negative. The money went out. What are my inflow in each of the years? I get 0 in year 1 because it doesn't pay interest or coupon. I get 0 in year 2. It doesn't pay interest or coupon. Year 3 also I get 0 of coupon. But In addition to 0 from coupon, I get back 10 million naira as what I realize. And that is that. At the end of the day, what is the net cash flow? I'll sum everything up across the board to show that I had outflow at year 0 and I had inflow at year 10. Invariably, what have I done? What I've simply done is that the difference between how much I invested 3 years ago and how much I realized today, 10 million, is my finance income, or what I can call investment income, as the case may be. Okay, now the issue then is this: how do I amortize this 900 over 3 years to recognize my interest? Should I divide it by 3 and say 300,000 each year? The answer is no, because it's not scientific. We need to use effective interest method to amortize. But to do that, I need first my effective interest rate, which is a rate that will approximately equal the present value of 9.1 million, which already has present value, and the present value of is zero and 10 million back to today's value, and sum up to 0. Therefore, what do I do? Therefore, I can make use of a function in Excel, and I make use of what I call IRR, which means in similar way as I've done it here, I can do IRR. And what is IRR? I'll say is equals to IRR. I open the bracket and I can open the function from here. And what does the function say? It says, give me the value. And I'm taking the value from 0 to this. And it's already seeing it with respect to years, which means he has seen that the first item he picked is year 0, the second is year 1, the third is year 2, and the third is year 2, and the fourth is year 3. And he will tell me to guess a rate. I need not guess a rate. I can leave it blank and I can guess in order to improve my guess estimation. But again, I must decide not to guess, and I'll leave it blank, and it's going to give me similar rates, and which if I expand, we are getting similar results, and that is that. Okay. Now, this is the second way of getting it. There's another third way of getting it. Okay, another one I can use is what I'll call go seek. Okay. Now, go seek is also within Excel model, but what kind of go am I seeking? The goal I'm seeking is that I'll expand this and say, okay, let me find a discount rate and let me just guesstimate a discount rate. And doing so, what do I do? For my guesstimation, I'll try to iterate, and it's going to produce a result for me. What does that mean? Now, let me assume that I don't even know what discount rate is, and I say it's 10%. I put 10% here. And that's okay. Let me use 10% to discount and see whether it will equate the present value of this outflow with the present value of this inflow. And I'll come here. If you recall, discount factor if you recall, the discount factor in period N is 1 over 1 plus R raised by N, or 1 plus R raised by minus N, any one you use. Therefore, I'll use the second one, which means I'll say is equals to 1 plus R. What is my R? I've estimated it to be 10 or guesstimated it to be 10. Okay? And raised to power minus N. What is my N? I'll pick them here so that it is dynamic. My first N is 0. It give me 1. My second N is 1. It give me this. My third N is this. It give me this. My fourth is this. Okay. Okay. Sorry. Okay. Now, what then is the present value? I multiply the two together, which means this, the net cash flow multiplied by the discount factor. I'll do it across board and produce this. And let me sum it up. It gives me this. Now, what I am working towards, is I'm working towards 0. I'm working towards 0. I'm working towards 0, but what I have is negative 1 point something million. If I change this to 9, I remember the higher the discount rates, the lower the present value. The lower the discount rate, the higher the present value, which means for me to take this from negative to positive, therefore I need to lower my discount rate. Let me lower it to 9%. It's coming down. Let me lower it to 5%. It's coming down. Let me take it to 3%. It becomes positive, which means my answer is in between 5 and 3%. But instead of wasting time and doing trial and error, there's an Excel function that can easily do trial and error in a second or 2 seconds, depending on how complex the model is. And what is it? We call it go seek. And what is it? I'll click on this. I want this 51417 to become a 0. Let it tend towards a 0. Therefore, I'll come to my home page here. I'll go to my data. Can you see the data tab? You now go to what if analysis. From there, I can see scenario manager, go seek, and data table. What is relevant for me is go seek. I'll click go seek, and it brings this tab. Now, this tab is highlighting that this is a goal I want to seek. And I want to seek it to be what? That what is the value. I want it to be 0. And I'll type a 0 inside. Because that is what I want to achieve. Because the sum of all present values should be 0 for me to have IRR, which we are now calling effective interest rate here. Therefore, and what is the variable that will influence that? Is my discount what? Rate. Which means my discount rate of 3% here. I can put anything there, or I can even leave it blank. And once I click it, it will work out my goal. And within a second, it has given me my results. Does that make sense? But it comes with a limitation. The limitation is that it won't give you the formula. It's just going to work the answer for you. And the problem is that unlike the first two, that if I change my parameter, they will automatically compute. But GoSeek will not compute because it's not using formula. It has only worked it and has given me the output. Therefore, if I change this parameter now and I change the information to 12 million and I change this one to 11 million, you can see that these two will give me my results, but this one will not change until I go back again to say I have negative 80, I want to make it to 0. I go back, seek my goal and say, this minus 80, I want it to be 0 by changing this variable. And what will you give me? That's the only limitation of goal seek. And that is that. And which means effectively, we have determined the effective interest rate. But without Excel like this, it might take time to mathematically solve for it, or you might not be able to solve for it in an examination condition. That's why in the modern day world, where you are now doing computer-based exam, you will have access to spreadsheets where you can be able to do that. But when you are still doing paper-based exam, which is not a reality, you will be given the effective interest rate in most cases, because you might find it difficult in an exam condition to derive it. But where you are more or less doing it in real life world with a spreadsheet, you can get it on a platter of gold, having the understanding of it all. Any question before we go to question B? Any question? Any question?
Okay, thank you very much, sir. My question is, although it might sound somehow, but I just the question is, what's the difference between this face value and although I understand the purchase price, but what's the meaning of the face value? Is it the fair value of the item or the what's it called feature value? I don't really understand.
Face value is a feature value. What it means is that somebody is issuing bond to say, if you put your money down now and you buy my bonds, which means you lend me money and you take a bond. Bond is like a paper showing or acknowledging that I'm owing you and that peradventure I can't pay. You can use this paper to more or less put on my asset to get back your money from the realization of asset. That's what bond is all about. Now, the person is not saying, I won't be paying you interest on a yearly basis. What I'll do is that I'm selling a discount bond. A discount bond means that you pay less and get higher value, which means if the bond value is 10 million, you pay less than 10 million and you get 10 million after the due date. The difference between the 10 million you get and what you paid is your own income for lending me money. Do you get what I'm saying now?
Very well, sir.
Yeah. Okay, let me go back to our 10 million and 9.1 million. And this, we always have to, this goal, we have to be seeked once a time, which means it does not solve all problems. You use it once a time and it will solve your problem once that time. Okay. Now, what is my amortized cost schedule? And that's where the old effective interest method and amortized cost comes to play. Remember, at the first day, your amortized cost and your fair value will converge. And what is your fair value? Your purchase price. You invested 9.1 million. And the entry you pass in your first year is as follows. I'll show you the accounting entry. Okay, now what is it? You bought the bond for 9.1 million. This was the entry you passed in your first year. And what is it? You debit your financial assets. Remember, it's a financial asset because you are the one investing. And you credit your mode of payment, which is bank. Invariably, what did you have? 9.1 million. Okay. This 9.1 million is what you have reported here as your amortized cost at the beginning. And in this question, there was no transaction cost. Now, at the end of year one, you incur interest. And the interest now is, we want to, this 100 income, interest income, we want to recognize it over a 3-year period. A lazy man way will say divide it by 3, and it is 300. But we said no. It doesn't satisfy the methodology. Therefore, what do? You recognize the interest on the basis of effective interest rates, which is the rates. What is our rate? This rate. You multiply it by the opening balance, since you are accruing it for a whole year. It means you are recognizing 290, 620 in year 1. Your amortized cost at the end of the year will not be the sum of your opening balance and your interest, which is 93,90620. This is your amortized cost at the end of year 1, which you bring forward at the beginning of year 2. Year 2 also, you recognize the interest, assuming the interest rate will not change because it's our effective interest rate. And I recognize it also on the second year, which is the same interest rate on the opening balance produces this 2991. And at the end of the day, what is my amortized cost? At the end of year 2 is this, which is my opening balance in year 3. I do the same thing for year 3, and I get 309,479. And what is my amortized cost as at the maturity of the bond? It is 10 million. And that's the objective, so that all what you have amortized is that you have amortized this 900 over a 3-year period in a systematic manner that produces this result: 290,620 in year 1, 299,901 in year 2, 309,479 in year 3. Which then means that in each of those years, I'm now going to recognize my interest as follows, which are the subsequent measurements. And what is it? My interest as follows. Year 1, I can transpose it. Sorry. So I'm taking it one by one. I can transpose it. Okay, sorry, because I've marked the cell. I'll just pick it one by one. Year 1, year 2, and year 3. What do you do in each of those years? You increase the value of your financial assets and you credit the increment as a finance income to your profit or loss. Now, what then happen at settlement dates? At settlement dates, you realize it whereby you get back your 10 million. And when you get back your 10 million, you debit the mode of your receipt of the money and you receive it into your bank account, mode of receipts. And you derecognize the financial assets by crediting it to nil it off. And at that point in time, what do you have? You have 10 million, which is this amount. And that is it. Does that make sense now? And that is it. Now, all of this is premised on the fact that the category we are giving to this bond is what? This bond is measured at amortized what? Cost. Why? Because it's a debt security and we have no basis to estimating it at any other value. Okay, we have no information that says otherwise. And on that premise, why do we take it as amortized cost? We take it as amortized cost on the following conditions. Let me show you once again. On the condition that one, it is a debt security where it has contractual cash flow predetermined. That's why we can estimate it, and of which such debt security has passed both the business model test and the contractual characteristic model test. And that's what we've done in this case. Any question on it? Any question on it? Any question on this? I want you guys to ask questions when necessary. Now we'll look at, okay, somebody want to ask a question?
I'm sorry.
I just want to ask a question. Assuming this estimated cash flow, like for instance, when we're trying to look for the IRR formula, assuming instead of, let's assume we are building a model and maybe the first 5 years of the transaction, the first year we have our outflow, and then the following year, instead of making profit, we make loss.
We're not talking of profit or loss here, we are talking of cash flows. We are talking of cash flow relating to financial instruments.
Okay.
And that's what do you mean by loss or profit?
Okay, don't worry. Like, I'm just trying to say that, for instance, you're building a financial model, because eventually, when you're building a financial model, when you want to estimate, maybe you look for the IRR of the business valuation. Now, that's what I'm talking about, not a business in valuation of a business. And there are times that, outflow, when the inflow of a business, maybe we are doing financial valuation, it's from your projected profit that you arrive at your inflow, maybe after considering some element of free cash flow. You know what I'm talking about, sir?
Yeah, what now is the question here?
So my question is that, do we consider the outflow, in the year one, instead of having inflow, we don't have an outflow? Do we still consider it as an outflow for that year one, or we just assume that it's an inflow?
It is what exists that you put. If you have, naturally, if you are doing valuation, there must be probably, if you have inflow first, which means other set of cash flow might be outflow, and it can be interwoven or oscillating. It is what it is that it is. You are not working towards an objective of trying to manipulate. No. What exists is what exists, and that is what you want to find the present value. Very simple.
Thank you.
Okay. Now let's look at another question. In this case, we look at a question where we have intermittent cash flow, which means the cash flow will not be 0, and up to the final. The cash flow might be intermittent. Therefore, let's look at this question. Let's look at question 3. Can you see it?
It's blank.
My question 3 is blank. Okay, let me come back. Okay, don't worry. Let me return here. Can somebody read question 3?
Ramsey PLC borrowed the sum of 1 million naira from Zoe Bank on 3rd January 2016 with a maturity date of 31st December 2019. The associated fee was 2% flat on the borrowed fund. The interest rate for the loan as agreed with the lender is 18% per annum. The effective interest rate for the loan is 18.74%. The term of the loan is such that interest are financed yearly, while the principal sum is paid at a lump sum payment at the maturity of the loan. Required A, construct the amortization schedule for the amortized cost measurement. B, show the relevant account entries for the respective years. Thank you.
Okay. Thank you. Okay. Now let's look at it. Again, let me drop the timeline. In this case, we have a loan. And this loan which is borrowing, I'll classify it as financial liability, have we? And this liability, since we have no ability to trade on it, and we have not designated it as fair value to profit or loss, automatically it will default at amortized cost. Therefore, that's the position. Now, the loan, I come here, don't mind my straight line. This today, period 0, period 1, period 2, period 3, and somewhere period 4. This loan, from the information here, is 1 million naira, which I borrowed on 1st of January 2016, and is going to mature on 31st December 2019. It's 4 years apart. Okay, how do I know it's 4 years apart? You can know with this stuff. If start date is 1st of January 2016, and maturity date is 31st December 2019. Therefore, I can find with the aid of Excel date diff. I'll get it to say date diff, the beginning, the end, and I want you to give me in years, which is Y. Sorry, which is Y. And therefore, which you can see if I open it, that's what I'm trying to do, which is Y. But because I have that, and I can have my 4 years, picking inclusive of the last day. Okay, that is that. You can get it in that manner. But again, you can use your hand to count the whole of 2016, the whole of 2017, the whole of 2018, and the whole of 2019. But that is that. Now, I borrow loan. The bank gave me how much? The bank gave me 1 million, which is inflow, positive. That's positive cash flow. Why? Because money came in. But as at that time, the bank charge me this fee on the borrowed fund, which means the bank charged me 2% on 1 million, which means my transaction cost in Naira is 2% of 1 million, which means in Naira terms, is 20,000, which means I will deduct 20,000. Net, what I have from bank is 980. If you remember this, we discussed it here. When you have a financial liability measure at amortized cost, you recognize at fair value, which relates to the purchase price. And the treatment of transaction cost is to deduct from fair value, which is what we've done here. We deducted it. That's the common sense in it. Now, how much am I supposed to pay back as interest on a yearly basis? 18%, which means each year for the next 4 years, I'll pay 18% of the principal amount as interest, 180, which means I'll come here and say my cash flow in year 1 is 180,000. My cash flow in year 2 is 180,000. My cash flow in year 3 is 180,000. And my cash flow in year 4 is 180,000 plus the principal amount I'm borrowing. Because of what? Here, the information says something here. It says the term of the loan is such that the interest are financed yearly, which is what we've done here, yearly. Why the principal sum is paid as a lump sum, which is otherwise known as bullet or balloon payment at maturity, which is what we want to talk about here. And what is that? The 10 million. I'll come here and write the 10 million. The 10 million. Oh, no, sorry, 1 million. The 1 million. Okay, if that is the case. And what then am I trying to do? I'm trying to discount all of this back to period 0. And to do that, I say my net borrowing was 980, if you remember, 980, this 980, which is 1 million minus, sorry, 20,000. Sorry, 1 million minus 20,000, 980. Okay, how much interest am I paying yearly? I'm paying, that's an outflow, 180, if you remember. And I paid for how many years? 4 years. Okay. And at the end of year 4, at the end of what? Year 4, I'm going to pay back what? The principal. Okay, what is the principal I'm paying back? I'm paying back the 1 million. Therefore, from there, I can draw up my net cash flows. I'll sum it across. Inflow in year 0 and outflow all through. Okay, and that is that. Now, let's come back here. For IRR, I can determine the effective interest rates. Remember, I can open it up and say, what are my values from period 0 to period 4? And I don't need to guess. And it will give me my rate to be 18.754444, which I think is close to what the examiner has given. Yeah, 18.754. And this is given because if it's a paper-based exam, but in reality, or computer-based, you have to derive it yourself. Now, I can also derive it with rates. Under that, I'll say rates. I'll open it. What is my period? 4 years. What is the payment? The payment is 180,000 each year as interest. What is the present value? The present value is 980. What is the future value? The future value is this 1 million, which I have to repay as a balloon. And the period is what? Is accrued at the end of the year, which is 0. And therefore, what does it give me? It gives me the same results. If I want to use GoSeek, I'll use GoSeek by saying, okay, even if I don't know what the rate is, I can leave it blank. I don't want to guesstimate. But again, my discount factor is 1 plus R. My R, I don't know what it is. I'll just select the blank. Raised to power minus this is 0. I'll link it with dynamic. And I draw it down. It gave me nothing because it assumed that what I put here is 0, which is the same thing as not putting anything. Now, what is my present value? I multiply my net cash flow with my discount factors. And I aggregate them, which means there's nothing different in these two. Okay. Now, what do I want to do with GoSeek is to say, what discount rate will make this thing 0? And I'll click on this once again. I'll go to my data tab. Under the data tab, I come to my what if analysis. I click on the GoSeek. I can see it's highlighted it. And what goal am I seeking? I'm seeking it to be 0 by changing what? By changing whatever the rate is here. And what does that give me? In a second or two, it gives me this, which is more or less approximate to what we have here. And that is it. Okay, but somebody say, why are we using GoSeek since it's not going to be able to change at every point in time? When you have a complex situation and uneven set of cash flows, the best methodology to use is the GoSeek. Okay, because then you can build your cash flow in tables and you can be able to capture everything at once. Okay, but the only deficiency of it is that you can only use it at a time. You can only seek a goal at a time. Every time you need a goal, you must seek it once again. Okay, that's that. Now I've sought the goal and we have gotten this, but we don't need to have done this because it's already given to us. But again, since we are not just looking at exam, we are looking at what can be of use to us in real life. Okay, that is that. If there's any question, please kindly ask me now.
Okay, the question is, when we're looking at the classification of financial instruments, we said that one of the things that will help us to classify, or one of the reasons for classifying a financial liability as amortized cost, is that it will have contractual cash flow characteristics. So the cash flow we have in here, is it the contractual cash flow? Because I'm seeing element of interest and what's it called? Interest and principal. So is it the one actually explaining the contractual cash flow characteristics, or do we have any special or anything? Because the question does not specifically identify something like that. I mean, a phrase like that. So that's the question I just want to ask as regard that.
Okay, I don't really understand your question.
Okay, maybe I should try asking again in this way. We said that as part of the reason for classifying a financial liability as a amortized cost, we said we identified two models, that is
Yes.
contractual cash flow models and the business model
The
test.
first model is the business model test.
Okay, and the second one is the contractual cash flow model test. Right. So now that contractual cash flow model test, is it the one that is being reflected under this net cash flows? Because when I tried confirming this, the meaning of this contractual cash flow test based on your what's it called, explanation, so I see that it requires the element of both interest and principal. So is it that this net cash flow is actually explaining the contractual cash flow element, or there's a specific area in the question that must explain that other than this net cash flow characteristic or this net cash flow value?
Okay. Now it's not about question, it's about reality. The issue then is that you say, in reality, you seek for information. For example, if you are a professional business reporting advisor to a company and they have financial assets, that is a bond, you will ask questions from them, and that question is to extract information that will support you in reaching conclusion on if they will have passed both the business model test and the contractual cash flow characteristic model test. What simply means is that you first of all ask them, sorry, what is your investment plan or objective regarding this bond acquisition you've made? You know, a company will have a policy or a board resolution which speaks to the objective to which they want to achieve by investing in a bond. And from there, you can be able to draw a conclusion that, okay, the company has an objective that let us take advantage of this bond because it produces a good stream of cash flow that we can use to meet up all our cash flow needs over the life of that bond. If you're able to reach that conclusion, therefore you say, okay, that means it has passed a business model test, or because the objective of earning this bond is that they want to have a constant stream of cash flow associated with that bond over the life of that bond. Furthermore, you investigate further to identify that, is it that they only have an interest or an objective, but is such an objective supported by the capacity to wait from the beginning to the end, which is the maturity of the bond, to only collect interest and principal without intention of selling that bond peradventure opportunity arises? If the answer is yes, therefore you say, okay, they've passed the second test. If the answer is what? No, they've not passed. But in a simple question like this, you can't even talk of fair value because you don't even have any information relating to markets, relating to whether it's a tradable instrument, which means the only default you have is to pretend that you have carried out an assessment and they both pass the business model test and the contractual cash flow. Because if not, if you say it's fair value, how do you measure it as fair value? Do you have any market index or indices to measure it as fair value? In this case, the answer is what? No. Which then means that why then do you want to classify it at fair what? Value. Am I making sense, sir?
Yes, sir. Yes, sir. Yes, sir. Thank you, sir.
Take note again. I continue to repeat. Financial reporting is not just about number calculation. No, it's about understanding the commercial transaction, the financial relation and economic substance of every business dealings for you to be able to appropriately account for it. Not just accounting from the angle of accounting, but accounting to reflect the commercial substance of what has been undertaken. Does that make sense?
Very well. Thank you, sir.
Yeah. Any other question? Okay. Now, the first question is to construct. We've not answered any question. We only try to recompute this to teach you how you do that in real life. But the next question is this. We should construct the amortization schedule. And the amortized cost schedule is this. Remember, at initial recognition, we recognize it as fair value less the transaction cost. Therefore, we recognize it at 980, which is 1 million minus this. And which you can also see from here. So 1 million minus 20, not 180, which is 980, which is simply as recognizing the financial liability at amortized cost. Initial recognition, it will be at your fair value, which is the price of 1 million. The debit bank, which is the mode of receipt of the funds. And you credit your financial liability, which is a bank loan. Transaction cost, instead of expensing, you use it to reduce your indebtedness. And the mode of payments, you charge it to your bank. And the net position of this is what produces this 980. And what's the effective interest rates? It's 18.754. We multiply by our opening balance, and we get our accrued interest expense, which is your finance cost for year one. But how much do you agree to pay contractually? 180 year one, which is interest only. Another 180 year two, which is interest only. And another 180 year two, which is interest only, whereas in the final year is interest and principal. Therefore, I'll come here, the interest only I paid. At the end of the day, what is my amortized cost? The amount I'm owing at the beginning plus amount I have accrued as additional interest, which I'm going to bear on the loan, minus, that's why it's a negative, the interest I've paid out. And that sum up to 983,793. This is my amortized cost at the end of year 1, which I'll bring forward at the beginning of year 2. Year 2 interest, since my effective interest rate remain constant, I multiply it by my opening balance in year 2, which give me 184,505. And I still pay interest only in year 2, which is this. Okay, as you can see it here. And my amortized cost in year 2 is 980,298, which is brought forward in year 3. My interest in year 3 also goes as thus, 185,349, which I paid 180 from my cash flow in year 3, as the case may be. And my amortized cost at the end of year 3 is this. Now, at the final year, my amortized cost, I brought it forward in year 4. My interest is 186,353 in year 4. And I'm repaying both interest and principal at the end of year 4, on the premise that each year I pay interest, and the final year I pay the last interest and the principal. At the end of the day, my amortized cost at the end of the day, having paid the last interest and the principal, will be 0, which means I fully extinguished my obligations, and that's what it means. Which means over the years, how much have I paid as accrue as interest? I've accrued 740 as interest. But how much have I actually paid as interest? The actual amount of interest paid is 720. Who can tell me what's the difference between 720? This 720. What is the difference between this 720 and this 700?
Transaction cost of 20,000.
Transaction
cost of 20,000. And that is it. What have I done? This 20,000, instead of me expensing it in year 1 or in the final year, I've amortized it over a 3-year period. How do I know? Let us look at it. Proof of amortized transaction cost. Year 1 to year 4, accrued interest and actual interest was paid. The difference is what? Amortized transaction cost. And what is it? Accrued interest are this. Paid interest are this. Therefore, what is the difference? The difference is 183 minus 180. And what do I have? I have this. Sum it up. It means I found a systematic way of amortizing the 20,000 over a period of 4 years. Now, can you now see that you can now better understand the definition of amortized cost? Because we are now seeing it in a practical sense rather than just the theory. And that is what we've tried to do here. Is it making more sense at all?
Yes, sir. Brilliant.
Okay. Now, which means when you sum up all of the cash flows, when you sum up all of the cash flows here, you have 1,720. But how much did you borrow? You borrow what? 1 million. Now, what is the difference? The difference is a contractual what? Interest, which is this. Okay? But in addition to contractual interest, you see incur 20,000, which makes it 740. Therefore, I can sum all of this up and you see it there. Now, what then do I do? Interest for each period. Year 1 was 183. Year 2 was 184. Year 3 was 185. And year 4 was 186. And that is charged as your finance cost to your profit or loss and credited to your financial liability. And each year when you make payments, you reduce your liability and you also reduce your bank balance by the so much you made as payment. This is what you pay in year 1. This is what you paid in year 2. This is what you paid in year 3. Okay, I'm supposed to link it to this side. And this is what you paid in the final year. And that is it. Now, are you seeing the reality of it now? Now, another thing we'll look at is, what if this is not interest-only loan where you only pay interest yearly, but it's a loan where you pay interest yearly and a portion of principal yearly, which means you are faced with what we call an amortizing loan. When you are faced with an amortizing loan, what then do you do? Which means the one we just solved here is what I'll call non-amortizing loan. Okay. And the one we've done earlier was amortized cost, where we had a deep discount bond. Now, we'll do another one now, where we have amortizing loan. The information are the same, but I'll wait somebody trying to show me where the differences lie. Okay, can somebody read this for us?
Sanogo PLC borrowed the sum of 1 million naira from Zoe Bank on 1st January 2016 with a maturity date of 31st December 2019. The associated fee was 2% flat rate on the borrowed fund. The interest rate for the loan, as agreed with the lender, is 18% per annum. The effective interest rate for the loan is 19.047%. The loan repayment is to be repaid yearly, both the principal and interest component based on annuity payments like required. A, construct the amortization schedule for amortized cost measurement, then B, show the relevant account entries for the respective years. Thank you.
Okay. Now, can you tell me what is the difference?
Okay, just like you said earlier, the difference is just on the last phrase, which says that the loan repayment is to be repaid yearly, both the principal and interest components based on an annuity payment, like unlike the first one where the where the entity is expected to pay the interest every year. So
okay, who else?
I agree with what someone said.
Okay, I'm waiting for who disagrees. Okay. Now, what can we do in this case? Now I've created a template now. The same question. But what is the difference? Just watch the difference. Now I drop my straight line again. This period 0, 1, 2, 3, and what? 4. Now I borrowed 1 million positive, and we had 20,000 negative. Everything comes to net positive cash realized, which is 980. But my cash flow in year 1, my cash flow in year 2, my cash flow in year 3, and my cash flow in year 4 are annuity payments. What does an annuity payment mean? They are equal amount of money I'm going to pay all through, which will cover for annuity payments, which will cover for both interest and principal over a period of 4 years. These are equal payments. And these payments include interest plus portion of principal. And the question then is, what is this amount? To determine this amount, we borrow a leave from the principle of present value of ordinary annuity. If you are familiar to annuity from business finance perspective. And the present value is simply saying that what is the principal value of the loan you are borrowing, and A is the annuity payment. If you're able to apply this formula, which I don't need to prove at this level, it's such that by the time I pay this amount over a period of 4 years, in this case, when I find the present value, it gives me how much I borrowed, which is 1 million naira. Therefore, we'll go back again. How much did I borrow? 1 million, which, as earlier said, I debit the mode of receipts and I credit the liability. Now remember that I borrow 1 million naira. The bank will give me a term sheet with a repayment schedule. How does the bank determine that? The bank determines it through various medium, which this formula will give us guide on. And if you are not familiar with this formula, you can also use GoSeek or a payment function in Excel. But let me use this formula first. Okay? This formula, how do I arrive at it? I'll go back and say, I know my present value. I know my present value. I know my rates. And I know my period. But the only thing unknown is A. Therefore, I need to make A the subject of the formula. In that case, A will not be, if you are familiar with it, by cross multiplication, the present value multiplied by this over all of this without A. And I should be able to obtain my A. But if you're not familiar with that formula, we'll use the Excel function. But let me start with that formula. The first thing is I need my present value, which is the money I borrow, 1 million. I multiply it by R, which is my contractual interest rate. Therefore, I've gotten the numerator. I divide it by 1 minus, open brackets, as you can see it here, 1 again, plus R, which is 18%, raised to power minus N, which is N is what? 4 years. Now, I have to close everything in that bracket in the denominator so that it takes it as its figure. Which means once I do that, I'm able to get 371,738.67 as what I need to pay every year that takes care of interest and principal, so that if I pay it over 4 years, I'll have fully extinguished my 1 million naira. And that is that. But instead of wasting your time using this formula, you can use Excel formula. But first, with this formula, let's see what happens before I will clean it up and come back again. It means interest the bank will accrue is 18% on this 1 million. The bank will tell you to pay 180 and it will accrue 180. And every year you pay how much? This amount, which include that 180 plus a portion of principal. Okay. Okay, which means from the bank term sheet and the repayment schedule, what we are standing at end of year 1 is 808,261. The same thing, you carry the balance forward in year 2. You do the same thing. Remember, the interest rate is not changing because it's not a floating rate loan. And you are still also going to pay the same principal, all things being what? Equal. And your interest is now 145,487 because it's now charged on a reduced balance. Okay? And your balance at the end of year 2 will be 582,010, which will bring forward in year 3. You do the same thing in year 3, your interest reduced to 104,762, and you pay the same amounts. You always repay this interest. The excess over the 371 will represent the principal portion you are paying down. And that is it. You also bring it down to year 4. You pay the interest and the final principal. And by the time you bring it down, you have fully extinguished your liability. And that is what we try to do in this case. Okay. Now let me just do something on the side. What is the principal portion paid? Let me create a space here. What's the principal portion paid? Let me grade it out. The principal portion paid is the difference between this and this. Which means at the end of the day, the principal portion you pay is this, which is grade off here. And when you sum it up totally, what is it? It's 1 million. That is how the bank has created that schedule of repayments. Okay, that is that. Okay, that is that. Now, I'm saying that instead of this, I can equally determine this payment function directly. I can use this payment function to determine this 371. And I'll come here, I'll use PMT as a function in Excel. I open it from this function bar, and this is it. What is my rate? 18%. How many years? 4 years. What is the present value? I borrow 1 million. How much will be the future value? The future value will be 0 because if I fully paid interest and portion of principal yearly, the final year I should have a 0 amount left. And interest is accrued at the end. And therefore, what do I get? I got 371, the same amount. Which means instead of me wasting my time proving a formula, I can use the Excel function if I'm familiar with it. And I can equally use GoSeek. The beauty of GoSeek is that it can solve any problem once you have modeled any problem, provided it's only one variable that you want to influence. But if you are to use 2 or more variables, you can't use GoSeek. Rather, you use what we call Scenario Manager. Okay, the first one you see before GoSeek. Okay, in this case, we are using our GoSeek. What goal do you want to seek? Which means, let me assume that I don't know this amount. And I've modeled my interest rates based on this 18% across board. You can see it here. It then means that I assume I'm not paying anything, which means my balance of the loan is increasing. And I'm now asking that how much should I pay such that the balance of this loan should be zero, or such that the principal repayment should be 1 million, but the best one is to use this loan balance. Which means I'll say my goal is that at the end of the year, this should be zero. And for it to be zero, I want to pick a value from here, which I don't know yet, that will represent amount I need to pay on a yearly what basis, so that if I pay it as interest accrues, I will have the zero balance. Therefore, I'll come here, this should be zero, and I'll go here to my data tab, go to my what if analysis. Remember, I told you about scenario manager. We don't need it. What we need is to go seek, because it's a single variable we are seeking. And therefore, what value do I desire here? It should be zero. And what can influence it is whatever the amount I need to be repaying on a yearly basis should be. And what is that amount? You can see the amount I have to repay still comes to the same amount, 371. But again, the shortcoming of GoSeek is that when you click it, it's not giving you formula, it's just giving you the results. Unlike these other ones that you can see formula. And what the implication is that if, for example, I change the interest rate to 20%, others will adjust themselves, which you can see here, but GoSeek will not adjust until I come back here and say, okay, this given me balance on 78, which means this is not the amount I'm supposed to repay. Let me seek the goal again. Let me seek the goal again. I seek it again. I want it to be zero by changing this, because that's what I've linked. And what does it give me? It gave me the same result. And that's just the beauty of it. Any question? Now, what we have only done here is to build up this repayment plan, and we have not done anything, because this is that we are creating a payment schedule that the bank will have given to you. But we have not yet construct our own amortized cost schedule. Why? Because we then need to treat the transaction cost. What is the transaction cost? The transaction cost is the 20,000 naira we are paying, which is 2% of 1 million. This 20,000 which you can see here, how do you treat it? Remember the accounting entry. We deduct it from the fair value of a financial liability. And therefore, deducting means you debit it to financial liability, okay, and you credit it to our mode of payments, which is bank. Remember, your mode of payments. Okay, 20. Now the issue then is this. Our amortized cost at the beginning will now be 980, which is 1 million minus 20. And we need to determine our effective interest rates. And there are various ways we can do that. One, we can use IRR. And what's IRR? We look at our cash flow pattern. What then is our cash flow pattern? This is our cash flow pattern now. Therefore, what I can do in that case is to use my understanding of IRR to do that. And I can do that by simply creating cash flow pattern. I can call here, I can call it here I'll start from year 0, year 1, year 2, year 3, year 4. Okay, what are my cash flows? My net cash flows for each of those years. What are the cash flows? Remember, the net position I have was this 980. Where do I get 980 from? This 1 million minus 20. That's 980. But how much am I going to be repaying? This amount. I'll bring them here. Okay. Now, what then do I do? I'll now use my IRR. What is my IRR? My IRR is pick this value from year 0 to year 4, and I don't need to guess. And it gives me IRR of 19.045 days, which is close to what they gave me as 19.047. Now I can use rates. If I use rates, I open my dialog box. I need my number of years, which is 4 years. I need my payment. My payment is what I've determined, which is here already, or my payment function, as the case may be, any of them. What is my present value? My present value is 980, which I have here. Where's the 980? I have it here. Okay, what's my future value? Is 0 because I will have fully paid, and at the end of the year, it should be 0. And at that point, what do I get? I get the same amount. That is it. Or I use go seek. What is go seek? Go seek means I need to extend these cash flows. I'll do something similar to what I've done here. I just need a discount factor. Okay. Now, what's my discount factor? I don't know what it is, but I'll leave it blank here, which is this blank sheet. And I'll say, again, my formula, 1 plus R. What is my R? The blank space, which I don't know what it is, which I can guess. Raised to power minus N, starting from period 0, and I make it dynamic. Because it's not in blank, it's still going to give me 1 because the assume is 0. But I'm now looking for where the present value of all this should sum up to 0. Therefore, I go to my data, I go to my what if analysis, go seek, and I seek a value that will give me 0. What variable will influence it? This go seek effective interest rate, which is blank. Whatever I put there, it will be ignored and it will recompute itself. And what does it give me? It gives me the same rate. And that's what we're saying here. Which means anyhow you do it, you get similar results. And that is that. Okay. Therefore, I need my effective interest rate, which I now have now. And I can say my effective interest rate, which is any of this I pick, I multiply it by this. And how much is my cash flow? Each year, my cash flow I pay is this, and my amortized cost is this. I carry it forward to next year. I determine my accrued interest. and my cash flow remain constant, which I pay my amortized cost at the end of year 2, which I bring forward to the beginning of year 3. I repeat the same thing in year 3. I get my amortized cost in year 3. I carry it forward to year 4. I repeat the same thing in year 4. And by the end of year 4, I fully paid my obligation. And that is that. Which means invariably, I've been successful about doing that. Which means at the end of the day, I'm accruing interest of this amount in year 1, of this amount in year 2, of this amount in year 3, and of this amount in what? In year 4. Now, how much am I paying in each of those years? I'm paying how much? This amount, which I can also find here in year 1, the same amount in year 2, the same amount in year 3, the same amount in year 4. Therefore, if I do similar thing I've done, it means this is my principal portion of each year. Okay, and that is it. Now, let me sum it up. I sum all of this up. What does it give me? It gives me all of this. Sorry. And sorry, my borrowing is 1 million. Let me go back to 1 million. Therefore, this is my contractual interest. Okay. But what's the difference between my contractual interest and the other interest? I can copy it from here. No, sorry. Okay. Now you can see this and this are the same. This 486, which is this 486. Now, what have I sum up here? Okay, and that is that. Now, what has been my contractual interest is 486. What is my accrued interest here is 486. Therefore, what is the difference between it? I can do the same thing I did here to prove it. Let me just copy this schedule. What I'll do is my accrued interest is this. And my contractual interest is this. And what is the difference? The difference are this, which relates to the 20,000 naira, which is the transaction cost that have to be amortized. And that's what I've done here. That's what I've done here. Which means you amortize 6,650 in year 1, 5,911 in year 2, 4,671 in year 3, and 2,768 in year 4. Now, if you check this, this is amortizing higher value in earlier years because as at that time you have huge balance with you. And later years you have lower balance. Unlike here, where you amortize lower balance in earlier year, and big balance at the end because you continue to have good balance at the end, we continue to attract more interest than lower balance at the end. And in this case, this second one we solved is amortizing loan, which means we have seen two scenarios to which loan could come, whether it's amortizing or not what? Amortizing. And that is the position there, which means we have successfully done that. And now, what is our finance cost? Our total finance cost is 506. And what is our contractual interest? Our contractual interest is 486. What is the difference between the two? This minus this will give you that 20, which we have more or less proof, yeah, how we amortize it. Does it make sense to you? Does it make sense to you? And any question? Does it make sense? And any question?
Yes, sir. But for now, I have no question.
Okay. Don't worry, you have access to the worksheets and you can be able to trail it. Now, all of this has explained our discussion with respect to amortized cost. Let me take you back there. Now, can somebody now read all of these terms again and see whether you can now understand it better than before? Who will read?
Okay, terms. Amortized cost of a financial asset or financial liability is the amount at which the financial asset or financial liability is measured at initial recognition minus principal repayments plus or minus the cumulative amortization using the between that initial amount and the maturity amount and minus any reduction directly or through the use of an allowance account for impairment or uncollectibility. Effective interest method is a method of calculating the amortized cost of a financial asset or a financial liability or a group of financial assets or financial liabilities and of allocating the interest income or interest expense over the relevant period. Effective interest rate is the rate that exactly discounts estimated future cash payments or receipts through the expected life of the financial instrument or, when appropriate, a shorter period to the net carrying amount of the financial asset or financial liability. Fair value is the price that will be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. So,
thank you very much. And that expressed all what we've discussed so far. And in that light, again, what have we done today in terms of refreshing our memories is to say that we introduced the concept of IFRS 9, where we said IFRS 9 tends to majorly discuss on recognition principles, measurement principles, and other principles relating to financial assets and financial liabilities, with the exception of equity instruments, all because, unlike those two, equity instruments cannot be remeasured. And we said our starting point is classifying the financial instruments based on homogeneous factors, common factors. Okay, and financial instruments, which is the financial asset and financial liability. For financial asset, we can group it into three buckets: fair value to profit or loss, fair value to other comprehensive income, and amortized cost. And financial liability can be grouped into two: fair value to profit or loss and amortized cost. And what is the uniqueness? The bucket for fair value to profit or loss for a financial asset only takes into cognizance financial assets that are held for trading or those ones that are at initial recognition designated as such to be measured at fair value to profit or loss. And this is attributed to the fact that you want to reduce or eliminate accounting mismatches. And we also talk about derivative assets are always contained in this bucket. Whereas amortized cost measurement only accommodates debt securities. And debt securities are securities that have contractual cash flows. Okay, and not only that, they must have passed these two tests. The fourth test is the business model test, and second test is the contractual cash flow characteristics model test. The next one is the fair value to other comprehensive income, which is a default bucket for any financial asset that has failed to be grouped into fair value to profit or loss or into amortized cost. And this is always common when a company has taken an option, a fair value option, to do that, which usually comes with what we call an irrevocable right of election. This usually comes with what we call an irrevocable rights of election, which means you can reverse or you can classify such a financial asset out of these buckets again until that financial asset is derecognized. Okay, and we're going to see that when we get to a classification of financial assets. Now we also talk about financial liability. Financial liability, we have two buckets, fair value to profit or loss, and that takes into consideration financial liabilities that are held for trading, or those ones that because of you try to minimize mismatches or avoid it entirely, you designate such to be measured as fair value to profit or loss. And likewise, derivative liabilities should always contain in that bucket. Otherwise, any other financial liability will fall under the amortized cost bucket. And there's a consequence to this classification. And the consequence borders on initial measurements and recognition, which are the same across boards. And they are all to be measured at fair value, where fair value approximates what we consider the purchase price, except in a rare situation, which we might look at later. We look at treatment of transaction costs. We look at subsequent measurements at reporting dates. We look at treatment of fair value gain or losses where applicable. We look at treatment of dividend income where applicable, and we look at treatment of interest income. And likewise, how do we treat impairment losses and impairment gain where applicable for those classes of financial assets. And we also look at implication regarding initial recognition and measurement for financial liability at various classes, the treatment of transaction costs, subsequent measurements at each reporting date. We also look at the treatment of interest expense where applicable in this case, and also treatment of fair value gain and losses as applicable. All of this are what we have discussed, and extensively we make mention of something here, which I need to enlarge this. Now I make mention of something here. And what is it? I try to make you understand that when you have fair value loss, it goes as a chart directly to profit or loss. But when you have a fair value gain, it goes at credit to profit or loss to the extent that it is not related to the own credit risk of the company. And what is own credit risk? Is a risk of more or less rating or downgrading of the security as issued by a company that has increased the market rate to which it can borrow, thereby reducing the fair value of the liability, which more or less brings about the fair value gain. Such a fair value gain attributed to own credit risk should only be reported to other comprehensive income except where otherwise. And also otherwise is only when the gain can be attributed to market factor, which is generic to all entities in the market, other than what is specific or unique to the entity as a result of its own credit risk. Okay, which that means that in that case, fair value gain on financial liability have to be delineated into the component that is attributed to credit risk, which goes to other comprehensive income, and the component that's attributed to general market factors or changes in market interest rate that goes through profit or loss. And that is that. Okay, in the absence of that, I think that will bring us to the end of part 3. Now, end of part 2. In part 3, we'll try to look at those instruments we can measure at fair value. And in that case, how do we report them? The fair value changes, how do we account for them? And thereafter, we look at principles that border us on the recognition of financial instruments. We look at principles that border us on reclassification of financial instruments where it's practicable. And we now venture into impairment assessment of financial instruments using the expected credit loss model, starting from the general approach up to the level of simplified approach where we might be making use of provision matrix. All of these are what we are going to discuss in the course of part 3. Okay, in the absence of that, again, I want you to ask any question whatsoever it is. Otherwise, we'll call it a day. Any other question, contribution, expression?
Okay, the question is actually not directly related to this class. You said you're going to give us something on IS 41. Agriculture.
Yes, immediately after this class.
Okay, thank you.
You can also see directly on YouTube on my channel. Just check it. But I'll also say
okay.
And I'll send you some supporting material to it. Thank you very much. And God bless you. Good night.
Thank you, sir.